Welcome to Strictly Money. I'm Saijal Patel. Are you looking at ways to inflation-proof your investments? If you are, you may want to look at real estate investment trusts. Now, conventional thinking is that REITs don't do well in inflationary and rising interest rate environments, but that's not necessarily the case. To run us through the winners and losers in the REIT space is Dennis Mitchell. He's the CEO and Chief Investment Officer at Starlight Capital. Hi, Dennis. Great to have you on.
Hi, Saijal. Thanks. Great to be back.
I know a lot of people believe that REITs are something you actually avoid in an environment where interest rates are trending up. Can you explain why that's not necessarily the case?
Yeah, it's not necessarily the case because if you look historically at time periods where central banks have been hiking interest rates, what you find is that real estate and infrastructure, for that matter, have both outperformed. And we're seeing it this time around as well. The central banks in North America, the Federal Reserve and the Bank of Canada, have both started hiking rates, and their last hikes were both 50 basis points. And I'll tell you, since the end of February till now, both real estate and infrastructure have delivered positive absolute total returns, whereas global equities, US equities, and Canadian equities have delivered negative returns. And so I think some of the reticence or the hesitance to invest in real estate and REITs in particular, when central banks are hiking rates, is because investors think that as interest rates go up, the value of the real estate will come down and the cost of financing them will go up. But if you really look at REITs and how they're structured and designed, the complete opposite is in fact the truth. Most people who own a home have got some sort of mortgage. And when mortgage rates are going up, the only people who are concerned are people who are looking to buy a home and people whose mortgages are renewing in the next year or so. Everyone else who's got 2 or 3 or 4 years left on their mortgage term, they don't care. And so the REITs are the same way. As they see the potential for long-term interest rates to go up, they extend the maturity of their debt. So one of our industrial REIT holdings, their average debt maturity is now 10 years, and the average coupon is less than 2%. So rising short-term rates and rising long-term rates have no impact on their cost of debt. Similarly, I think when people see interest rates going up, they're worried about the demand for real estate. But in inflationary time periods, economic activity is robust. Companies are looking for more space. And so as a result, you normally see rents go up. In fact, a number of rents have actually got direct inflationary ties to them, such that as inflation picks up, so does the rent, which grows the REIT's cash flow.
Okay.
And we've seen that in distribution increases as well.
It's interesting when you talk about the structure of the REITs and the way they manage their sort of debt, right? So do most REITs look 5-10 years down the road? Because I have to think like rates are going up now. They could come down next year. So is it longer term that they look at?
Yeah, so it really depends on the term of their lease. You really don't want to have a material mismatch between the terms of your leases and the term of your debt. So for instance, for the REIT that I talked about, they're an industrial landlord. Their average lease term is about 7-8 years. So having 10-year debt, especially below 2% on average, matches up well with the term of their leases. Now, if you have a multi-residential REIT where most of their lease terms are month to month or a year at the most, you're going to have shorter term debt of maybe 2 to 3 years, but that's still a good match. And it still means that the term of your debt is closely tied to the term of your leases.
Okay. Dennis, where do you think we are in the economic cycle right now?
Right. Well, you're looking at a time period right now where growth is slowing significantly. Some of it is just base effects. Last year, we saw the reopening from the COVID lockdowns, and so we had very strong and robust growth. And so year over year, when we're comparing to last year's time period, we're going to see slower absolute growth. But on top of that, you have things like the war in Ukraine. You have central banks tightening. And as much as we pay attention to the Bank of Canada and the Federal Reserve Bank, before either of those central banks got started, central banks around the globe had already hiked interest rates 150 times.
Right.
So the Fed and the Bank of Canada are late to the game. But when you put all of that together, high inflation, interest rates going up, policy rates going up, the base effects, the war in Ukraine, additional COVID lockdowns, all of that means global growth is slowing. And then we're in a weird situation, Saijal, where for the better part of 14 years, we had interest rates at emergency levels, despite the fact that GDP growth was robust.
Yeah.
Now we have GDP growth slowing and the US actually printing negative GDP growth for Q1, and we're hiking interest rates.
Yeah.
So it's a bizarre mismatch and demonstrates the proverbial interesting times that we live in.
Welcome back. Dennis, before the break, we were talking about where we are in the economic cycle. Do you think that we are headed for a recession? Can we avoid it?
Well, I hope so, but I think it's a very, very narrow path going forward for central banks to avoid recession in North America and Western Europe. So I just think that with the combination of the war in Ukraine, supply chain bottlenecks in Asia and the tight labor market in North America in particular, it'll be very difficult to avoid recession. But I don't think it'll be anything approaching what we saw out of the financial crisis or out of the pandemic for that matter.
Okay, so they'll hike rates and then they'll have to cut, really.
Yeah, and interestingly enough, markets right now are pricing in the Federal Reserve in particular hiking to 2.5% and then cutting back to 2%. So they're already factoring in that the Fed is going to hike too much, create a recession that requires some accommodation. My own thoughts are that the Fed probably will not be able to hike as much as the market is expecting, because quite honestly, inflation is, the things that are driving inflation right now, the war in Ukraine, supply chain bottlenecks, those things are not going to be solved by a higher Fed funds rate or a higher overnight rate. So I don't believe the Fed or the Bank of Canada will be able to hike as much as the market is currently forecasting.
Okay. So let's talk about REITs. Which types are you favorable towards?
Right. With any sector, any investment, you really should be looking for long-term structural growth. And so what are the sectors in the real estate space they're exposed to that? And probably the easiest one right now and the most prevalent one is industrial real estate. There really is tremendous, almost insatiable demand for more industrial real estate. And that's driven by a number of factors. One, if you start looking at the costs for multinational companies to bring their goods to market, you think of companies like Nike or Home Depot or Starbucks, almost 40% of their costs are tied to transportation. And so when you see oil rising to $100, $110 a barrel, you can imagine that their transportation costs are going up significantly, and that's material. Now you compare that to their rent costs, their rent is only about 5 or 6% of their costs. So they can absorb significant rent increases on that side of the ledger in an attempt to avoid or reduce the 40% that's tied to transportation. So what does that mean? More local production, more demand for local industrial and logistics assets to support that. And so that's in fact what we're seeing. So the REIT that I referred to earlier, they are already seeing 29% rent growth on a cash basis, meaning that the tenant who is coming in is paying 29% more in cash today than the tenant who was left was paying. And if you look over the long term, if you took their entire portfolio and mark the rents from their current rent levels up to the market level, you'd see 48% rent growth. So again, that sounds huge and it sounds unsustainable, but when you put it in the context of these large multinational corporations and how much of their cost structure it makes up, they're happy to absorb a 50% increase in a line item that's only 6% of their costs in an attempt to avoid any sort of growth in a line item that's 40% of their cost base. So we see the long-term growth and demand in industrial real estate, and that's why you're seeing significant funds from operations growth in those names.
Okay. Dennis, we have about a minute and a half until the end of the show or your segment. Can you give us your thoughts on office REITs? Always interesting, right? Because we are seeing the shift to hybrid, work from home. What are you seeing in the space and how do investors evaluate this space? Because not all office REITs are created the same.
Right. So I'll give you two answers. The first answer is really short. Investors should avoid the office space and they should allocate capital to industrial and residential storage, cell towers, data centers. Those are all sectors that are easy. They're growing. There's no hair on them. Buy them. You'll be happy.
Okay.
In terms of office, if you're going to look at office REITs, the challenge you have is now you have to, you don't just underwrite office, you have to underwrite almost each property and their tenants, because some of the tenants are like, everybody's coming back to work and we're all working 5 days a week. Some of them are like, listen, we'll figure it out. It'll be some sort of hybrid model. If you look at where we were headed before the pandemic, we were headed towards some sort of hybrid model. And a lot of people have said that the pandemic has simply accelerated existing trends. So that to me means likely less demand for office space going forward, exacerbated by the pandemic. And now you have the added variable is you have to consider the policy of the individual tenants. That is a lot of work to do. Your risk and your downside is significant and material versus just allocating capital to the names that are easy to analyze and will give you that surefire growth.
Okay. Dennis, we appreciate you coming on today. Thanks so much.
Thanks, Saijal.
Dennis Mitchell of Starlight Capital. Welcome back to Strictly Money. Have you bought a stock, sold it at a profit, and thought to yourself you're a rock star investor? Or have you bought a stock and it's lost half its value, but you can't bear to sell it just in case it recovers? I have news for you. You're being influenced by behavioral biases. You see, the most rational traders, as disciplined as they set out to be, are vulnerable to taking shortcuts, display overconfidence, and let their emotions get the best of them. Sam Sivarajan is a behavioral scientist and the CFO of Telostouch, and he joins me now to walk us through these biases and how to make better investment decisions. Sam, great to have you on.
Thank you for having me on the show, Saijal. Nice to be here.
Yeah, so I'm glad you're here because behavioral finance, to me, is the heart of successful investing, but it's not widely talked about, right? So in your experience, can you talk about, why it matters and why investors need to pay more attention to this?
Yeah, that's a great question. Behavioral finance matters because emotional investing, which is what we're really talking about, costs investors around 5% a year. So if I can put that in perspective, if you had invested $1,000 10 years ago, the average investor would have about $1,300 today. But an investor who could better manage your emotions would have more than $2,000. So there's a gap that comes due to the emotional investing, and this gap is caused by greed and fear. We buy near the top of the market because of greed or the fear of missing out on the market, and we sell near the bottom because of fear of losing money. And we've seen these patterns repeated over and over again in 2008 when there was a correction in the market, or in 2020 with COVID lockdown and there was a correction in the market there.
Yeah, and we're probably witnessing it a bit now, too, while we're seeing this correction.
We are seeing what happened in April, absolutely.
Yeah. So why does this happen?
Well, it happens, Saijal, because we are amazing data collection machines, but not so great at data processing. So our 5 senses collect 11 million bits of data every second, but our brains can only process 120 bits per second. So it's like drinking from a fire hose. So to cope, our brain takes mental shortcuts, like the habit of brushing our teeth on a daily basis. And we do this so that we can function daily and that we don't have analysis paralysis. Now, 95% of the time, this automation works great, but sometimes it can hurt us. And that's where we have to be aware of the behavioral biases and take steps to manage that in our decision making.
Okay, so let's run through some of those biases. Anchoring bias. So this is where people overestimate the popularity of something. Is that right? How does that apply to investing?
So anchoring, so I think you're talking availability.
Oh, availability, sorry, yeah.
But anchoring is where people make decisions that are based or influenced by a particular reference point or anchor. So I'll give you an example. Right now, people are buying or selling homes, and they focus mostly on the recent hot market activity instead of looking at a longer time track record, et cetera. Or people selling stocks focus on the price, and I think you said it at the outset, they focus on the price they paid for the stock rather than whether that stock still makes sense. So how do we manage this bias? Well, one way is to be critical in our thinking. For housing, for example, we can remind ourselves that there have been market corrections in the past, and we can ask what's different today in this market. Another approach is to take the outside view. So ask ourselves, have others faced the same situation and what happened in those cases? So again, from housing perspective, an outside view would look at the real estate market around the world and their experiences with market corrections, and not just the recent Canadian experience.
Okay, and then availability bias. So that's where people overestimate the popularity of something, right? How does that apply to investing? We have about 40 seconds.
Well, I think that's anyone who's bought a car, a new car, knows that they suddenly notice more cars of that brand on the road. So you're absolutely right. We see this with meme stocks today. That's availability bias. A small group of supporters overwhelmed the majority who were silent. So we may think of this as a more compelling investment. One way to solve it is what Charlie Munger, Warren Buffett's partner, calls inversion. So solving problems backwards.
Okay.
And challenging our initial assumptions.
Okay, got it. We're going to take a quick break. Stay with us. Welcome back. We've been talking about behavioral biases, and Sam, we talked about anchoring biases as well as availability biases. Let's talk about overconfidence bias. So obviously, when investors are overconfident in their investing abilities, how does someone manage that?
So I think overconfidence is a very common bias in investing because we don't have a very realistic view of our own abilities or shortcomings. So this is why 90% of drivers think that they're above average, and why overconfident investors underperform by about 7% a year. So one way for investors to manage this bias is to conduct what is called a pre-mortem. So before making the investment, think a year from now, this investment has gone down by half. Write down all the reasons that could have caused this investment to go bad. And this practice will help the investor limit the impact of overconfidence on their investment decisions.
Do you think, Sam, creating a list of why you're buying a particular investment and when you should sell would help? Like, I call this sort of an investment policy statement. Do you think it's as simple as that, or even just trading less?
Well, I think there's a combination. I think trading less, obviously, I think helps. But I think you're onto something with as a checklist and putting in a form of IPS. So many investors have a stop loss in place. But what you're suggesting, I think, makes a lot of sense, to have a stop gain as well. Like, what do you think is a likely target price for your investment, and what you might want to sell it at, so that you don't hang in there on the losing end, or keep staying greedy on the top end as the price powers through. And we've seen this happen in Nortel. Well, people never sold, because it was going to keep going up and up, and we know differently.
Yeah. Well, and speaking of which, when it went down and down and down, which leads me to the last one, loss aversion bias, right? So this is a tendency where people just have a strong preference to avoid losses rather than obtaining gains. They feel more pain when there's losses versus pleasure. How do you get around that?
Well, I think you hit a nail on the head. This is why that loss aversion is why we buy insurance, why we sit on cash in the bank account, and why we sit on losing stocks, as you alluded to. This is a hard one because this is how we're wired. But some things investors can do is that they can try framing the decision differently and write this down, but to highlight and balance the potential gains versus against the loss. Like, what else could you do with the money instead of continuing the path, to stay the course? And of course, while it is easier said than done, I think investors need to be hyper vigilant about letting emotions take over their decision. This is again where your comment about writing down a simple IPS or what the gain, what the target price might be, or where the loss price, the limit price that they might have, can help manage this bias from wreaking too much havoc on their portfolios.
Okay. Sam, biases affect everyone, like I said, right? Traders, advisors, and you're the CFO of Telostouch, which is a platform that helps some financial institutions get a deeper understanding of their clients. How can advisors help themselves, I would say, so they can serve their investors better? We have about a minute.
Well, I think that there's the analogy of the rider and the elephant, the rational and the emotional brain. The issue is that the advisor can't control the client's emotional brains, but they can help the clients understand that it's less about beating the market and more about beating their emotions. Because after all, there's a difference between what we say we do, what we actually do, and what we should be doing. A good example of this is drinking. We tell our doctors that we drink 2 glasses of wine a day. We actually drink 3. And at most, we should be drinking 1. So advisors can help manage this behavior, but to do so, they need to understand their clients way beyond the traditional risk tolerance questionnaire and know your client rules. And these are some of the tools that we build at Telostouch to help advisors to motivate the right behavior at the right time to help the clients control their emotional or elephant brains.
Okay, Sam, we really appreciate you coming on today. Thanks very much.
My pleasure being here. Thanks for having me. Saijal.
Sam Sivarajan, behavioral scientist and CFO of Telostouch. Well, we've come to the end of this show. If there are financial issues that you want to hear or learn about, please drop us an email. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.